most people say you can't time the market, I say you have to. I'm Scott Redler, Chief Strategic Officer for T3 Live. I would like to invite you to an exclusive swing trading event in Newport Beach, California on Saturday, February 23rd. Students will learn the 5 keys to becoming a successful swing trader and how to navigate the market using what I call a portfolio approach when it's conducive in the market. Reserve your seat at t3live.com or call our toll-free number 1-888-99-T3-LIVE.
Good morning, everyone. This is John Darsie here, going solo with the morning call. We have Scott Redler, Pete Renzulli, and Bob Wahlberg en route to Newport Beach, California for the latest Active Trader Summit, which will be tomorrow. If you're on the West Coast in California, a drive away from Newport Beach, I would definitely recommend going. It's going to be a swing trading focused Active Trader Summit with Scott as the main presenter, so I think it'll be a really great event. The tickets are very cheap, so I would definitely, if you're in the area, try to make it out there. All right, we'll jump right into the market. The last 2 days we had a little bit of a change of pace with the first major pullback of 2013. We pulled back about 30 handles in those 2 days, and this will likely change the speed and composure of the rally, but it still feels like we're going to go higher. And this morning, we're getting confirmation of that thesis a little bit with futures up about 8 handles before I came in here. If we'll take a look at the spider chart really quick, you see that pullback from highs. It was very harsh because a lot of it happened intraday. It wasn't a gap and go to the downside. It was the day of Fed minutes on Tuesday, or I guess that was Wednesday. It sounded like the Fed is getting a little bit more hawkish. They're going to maybe take the punch bowl away with QE a little bit rather than having infinite QE, which sort of rattled markets a little bit. World markets sold off, U.S. markets sold off. And then we got some follow through yesterday to take us below the 21 period moving average barely. And this morning we're opening, back sort of up into the 8-day moving average around this 151.32 area, which, it'll be very interesting to see what happens during today's session about whether, it's just a gap and fail or whether we really gap and squeeze those shorts that are still trying to sit in shorts from the last couple of days, which Scott talked a lot yesterday about not to get greedy from the short side. I know, the market's run a long way in 2013 and it's a little bit of a sexier trade to try to catch that top and try to get a really big pullback in the markets, but when the market has this really strong composure in a macro sense, you really have to have a very small expectations for shorts and be very willing to take profits early in that trade. We talked a lot about different sectors that have been leading the market higher and about corrections are an opportunity for you to identify relative strength and potentially buy those strong sectors and strong stocks on dips. We've been talking about the financials, for example, that were it was the sector ETF, the XLF, that held up the best. We'll go take a look at the XLF, and then we'll get into a couple bank stocks. You see the XLF, on Wednesday when the market broke down hard through its 8-day, you had some other sectors breaking down hard. The XLF barely closed below its 8-day. And yesterday, it also did close below its 21-day, but it definitely held up a lot better than most other sectors. And this morning, you're seeing a lot of the bank stocks open up fairly sharply higher. Goldman has been the strongest one in the group. If we take a look at that chart, it held above its 21-day, which is a very constructive sign. And I'm going to go to the 5-minute here just so we can see the 24-hour chart. You can see where Goldman is trading in the pre-market. It's up at 152.62. So you can see some nice pre-market action in Goldman that takes it back up above its 21, or it's going to remain above its 21-day and potentially look to test the 8-day again today. That would be a name that I would look to if we can get some strength early on after this gap up. You look at Bank of America. It's one that Scott has been focusing on. It did have a little bit more of a complexion change, which it closed below its 50-day, which is not something that bulls really like to see. We're going to go to the 5-minute chart on that one also to see the pre-market action. It's coming in a little bit in the pre-market, but it's still up here around 1160, which is some nice pre-market gains for this stock. It'll take it back up above the 50-day. So it'll be very key to see if we hold above the 50-day. Something with moving averages are a very nice thing to watch for speed and composure of a rally, but the important thing you want to see when a stock breaks its moving average is how long it holds below that moving average. It's something that Scott talks about a lot in his swing trader course, and we talk about a lot on T3 Live, is that you see a stock break below a major moving average, you don't short it immediately, because usually when it breaks below that moving average, it's a little bit oversold. You wait for some confirmation and a base to form over the next few days to determine, you know, what side of the trade you want to get on next. And if we see Bank of America, you know, it's going to open back above its 50-day, and if it trades impressively, you know, back up towards its 21 and 8-day, that's something that we will, you know, continue to look for long trades after some bases and consolidations form. We're also going to talk about Google. Even though the tech sector has been a little bit weaker, obviously, than a lot of the other sectors, due mainly to weakness in its biggest component, which is Apple, you've seen a stock like Google remain at highs and really, you know, keep the tech sector from really falling apart and really going to crap. But you see Google up here closed still around its 8-day moving average yesterday, you know, which is extremely bullish with the market breaking its 21-day. You see stocks like Bank of America breaking its 50-day, which is, we've seen that in multiple sectors and multiple stocks, but you see Google still holding above its 8-day. And then this morning, we're getting confirmation of that strength. Google's up above 802. You know, great pre-market action in Google. We'll see the high here on this bar is around 808, so that'll be the pivot to watch. You know, Scott always talks about those pivots to calculate your trades on, and even though Google seems a little bit extended, you know, you want to be buying these strong stocks on pullbacks and when the market firms back up. So Google, I think, should be an A+ play today if you're looking to trade on a Friday. We'll go and look at LinkedIn as well. It's a similar situation as Google. It's been extremely strong since earnings. It was extended a little bit from its short-term moving averages, and you know, just saw a pullback. It didn't even close near its 8-day. It came close to testing an intraday, but the stock is still holding up extremely well. We'll go take a look at its 5-minute to see where it is in the pre-market. It's up here printing around 159. It looks like it's a little bit thin in the pre-market, but it'll be interesting to watch that one today. That's another candidate that, you know, on pullbacks, that's the kind of stock you want to be looking to buy. And you know, it's back up here, and we'll be looking at this pivot. You know, this push through failure was a little bit of a sign of caution. It was almost an outside day. But LinkedIn is another one you could potentially look to the long side if you're looking to be in the tech sector and looking to play strong stocks. And then Netflix is an interesting case because this morning you have a negative note out on Netflix. I can't remember the source, but it's out there weighing on the stock a little bit. It's down a little bit in the pre-market. We'll take a look at the Netflix chart. This would be, in the absence of that note, this would be one of those that you'd be looking to play on weakness. You know, stock like LinkedIn has been very strong since earnings, held above its 8-day moving average. We look at it in the pre-market. We'll see if it's still down. See the sell-off is sort of accelerating in the pre-market. You know, you look at technicals and all that, but you also have to pay attention to the news wires and see what's coming out. And this is one that has been derailed a little bit by some news. If we go back to the daily chart, it's trading around 183. So it'll open below that 8-day moving average. The low of this candle is 182.50. So watch that pivot closely. And if we do break that, I think we could get a test of the 21-day, which, you know, given the size of this move after earnings, would not be an unhealthy or unexpected thing from Netflix. We would look for a potential pullback into that 21-day, and if that holds, we can get a base in that area. I think that'll be one that you should really look to potentially get long. There's still a lot of shorts that are trapped in Netflix that, you know, were piled in below 100, and those people are looking for a way out. And if we get a pullback into the 21-day, that could be the opportunity they take to cover, and it could be a buying opportunity. We'll also take a peek at the 3D printing stocks, not because we're going to be necessarily looking to buy those, but they've had a major complexion change heading into D earnings, which are coming up. You had that negative note that came out from Citron, which is the well-known blog that comes out with a lot of hit pieces on controversial and, you know, potentially bloated stocks. And they came out and basically made their bear case on 3D printing and about how the applications are not very broad, and, you know, basically you can just print plastic toys and stuff like that with these 3D printers, and it's not a viable you know, manufacturing solution, which is why everyone's so excited about this. People think that one day, you know, 3D printers could print body parts and print car parts, and they could really just revolutionize manufacturing. And that's the case that President Obama made in his State of the Union address, and some people are talking about a potential Obama top in these 3D printing stocks. So right now that would hold a little bit true after the harsh sell-off. You saw a huge sell-off yesterday in D. If you go back to the chart, breaking below its 50-day moving average, you know, you got some support. This little consolidation here around the $51, $52 area could provide some support, but, you know, there's really not a lot holding this back from pulling back even more. We'll take a peek in the pre-market. I didn't take a look at it yet. It's actually up fairly nicely, so maybe put a hold on those comments, but I still think this is a broken sector, even if we do get some pre-market strength with the 3D printers, with the market's pre-market strength. We'll take a peek at SSYS. This is a thinner, less mature company in the 3D printing space, a thinner stock. and it has continued to bleed lower a lot more so than DDD. The triple D has sort of held up and then had harsh down days on a select number of days, but Stratasys SSYS has sort of just bled lower, and it's actually testing its 200-day moving average. And if you are bullish on SSYS and the 3D printers, a 200-day moving average could be a potential spot to test some longs. DDD doesn't look like it's coming as well into a support area that would be buyable, but SSYS maybe does. If that's your cup of tea, I know Mike Lee and Steve LeVay in the momentum trading room are going to continue to ride both of these 3D printing stocks to the long and short side until they prove that they're not, volatile and not able to show momentum and be conducive for that momentum type of strategy. We'll take a quick peek at gold to close out today's show. Gold is in focus around any sort of Fed announcement, whether it be the minutes or a rate announcement. We'll zoom out a little bit to the weekly on gold because I think it's a better way to look at it. Gold bugs or gold bulls, they basically look at this chart and they say, after just a monster, we'll even go out to the monthly. After a monster decade-long run, you see the GLD below 50 here in 2005, traded above 180. You see this, when you zoom out and you look at this consolidation, it looks like just a very healthy rest base consolidation in gold. And I think gold bulls will still be pointing to that in a macro sense that gold is still poised to go much higher, and it's your protection against all the ills that are central banking and central planning and quantitative easing and all that stuff that's highly inflationary. What they say about inflation is that right now, although it's under control, and inflation is like that glass ketchup bottle that you hit it on the table, you hit it on your hand, you hit it, nothing comes out, and then eventually you get just a deluge of ketchup on your plate. It sort of ruins your day a little bit, unless you like ketchup. And that's what people believe could happen with inflation, with all this asset buying and quantitative easing that the Federal Reserve and other central banks are undertaking right now. But you see gold right now, it's broken. We'll go back to the daily chart. I'll end my my little tirade on that. It's broken. On the Fed minutes, it opened lower that day, accelerated to the downside after the Fed minutes when they were a little bit more hawkish, and you had several Fed governors saying that the potential benefits of QE right now don't outweigh the potential dangers. It's becoming more dangerous, especially with economic growth picking up a little bit. QE might not be as necessary. But yesterday we saw gold stop the bleeding. It traded, almost took back that entire down bar from the Fed minutes day. This morning I think it's around flat, the GLD, but it'll be something important to watch, or something worth watching, I would say. It could bounce, but right now, gold is a little bit broken since breaking out of that wedge pattern. And with currency wars heating up, I still think gold could rebound and go to the upside. And that'll do it for today's morning call. Thank you for joining me, and I'll reiterate that if you're in California, in the area, and you don't have anything to do tomorrow, go by the Marriott Hotel and Spa in Newport Beach, California, where you'll hear Scott give several presentations, and Pete Renzulli and Bob Wahlberg, who's our CEO, who has some great macro thoughts. So if you're in the area, definitely stop by the Active Trader Summit in Newport, and we'll see you out there in the virtual trading floor today, and we'll be back at it next week.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.